What's up, everybody? My name is Joe Brown, and this is Heresy Financial. Today on Thursday, interest rates across the board started to spike all the way from the 2-year to the 30-year. This is leaving some investors wondering, why are interest rates spiking, given the fact that the Federal Reserve was very clear they will not be touching interest rates until their asset purchase taper is complete. And clearly they haven't started tapering their asset purchases yet, so why are interest rates going up? So we're going to talk about why interest rates are going up right now and what that means going forward. Ready? Let's dive in. First of all, it's important to recognize which interest rates the Federal Reserve is talking about when they're talking about either raising or lowering rates. They're specifically talking about the federal funds rate. That's all the way at the shortest end of the curve. That is not the 2-year, the 10-year, the 30-year that investors, financial institutions buy and sell to each other. This is important to note because the Federal Reserve does not yet engage in outright yield curve control. So what is the yield curve? And many people talk about yield curve control coming or is already happening. The yield curve is basically the plot of the shortest term interest rates all the way to the longest term interest rates from overnight all the way to 30-year, and then what those interest rates are along the curve. Yield curve control would be if the Federal Reserve or the central bank or whoever's in charge of monetary policy would set the exact interest rate for the entire curve. So they would make sure that whether you're looking at the 2-year, 10-year, 20-year, 30-year, it's at a specific interest rate that they want. In reality, the Federal Reserve only directly controls the federal funds rate, and then they just rely on the impact that has on the rest of the curve. They don't outright control the exact interest rate that the 2-year, 10-year, 30-year has. But that doesn't mean that these interest rates are completely free of influence by the Federal Reserve, because they are a big buyer of these treasuries. And since the Federal Reserve prints money, and so they're coming into a market as a buyer with an unlimited pocketbook, and they are adding new demand to this space that's going to influence the prices of whatever they are buying, because without their buying, it would just be left to the free market to, for that buying and selling pressure to determine the equilibrium to come up with a new price. So the very fact that the Federal Reserve is purchasing some of these treasuries means that they are influencing the price, and it is higher than it would be, all else being equal, without their presence as a buyer. Now again, I need to reiterate, this is not yield curve control, full-blown yield curve control, because what they are doing is targeting a specific dollar amount of purchases, not a specific price of what they are purchasing. For an example, let's look at used iPhones. Lots of people have the iPhone 12 right now and are looking at upgrading to the new iPhone 13 that just got announced, and it will start being shipped pretty soon here. Now, depending on the iPhone model that you have and its condition, you can sell it online right now, private party, for at least a couple $100, or you can usually just trade it into Apple, which is easier and more convenient, for a little bit less than what you could sell it for online. But Apple's got a pretty big piggy bank, so if they wanted to artificially inflate the prices of used iPhones, they could do one of two things. They could target a specific number of iPhones that they are going to purchase from the market, and them as a new buyer coming into the market would drive the prices of those old iPhones up. So if they said, hey, we want to buy 1 million old iPhones, or 2 million old iPhones, or 10 million old iPhones, whatever the number is, that target of targeting a specific quantity of iPhones would drive up the price more than what that price of those old iPhones would be if they didn't decide to buy those extra iPhones. But that is fundamentally different than them coming in and wanting to drive the price of iPhones up to a specific price, and instead of targeting the number of iPhones they're going to buy, targeting the specific price they want those old iPhones to be. And if they wanted, they could go onto the used iPhone market and make every used iPhone cost $1,000. And all they would have to do is offer $1,000 for any old used iPhone. And because of their large pocketbook, they could do that. And nobody would be selling their old iPhones to anybody else who's offering $300 or $400 or $500, because you could get $1,000 by selling directly to Apple. So this is the difference between targeting a quantity purchased and targeting a price of what you're purchasing. Because if you have big enough pocketbooks, you can do either one, and they have different results. One result of Apple coming in and targeting, let's say, $1,000 price price tag for used iPhones would be that pretty much every used iPhone would get sold to Apple. They would absorb probably the entire used iPhone market because they'd be offering far more than what anybody else would be offering, and they'd be offering far more than is like a normal rate, what those phones are probably actually worth, and so everybody would jump on the chance to get some extra money. Now back to the Federal Reserve. What they're doing is like the first example of the iPhones, where they're just buying a specific dollar amount of treasuries every single month. And they know it's going to have some effect on keeping interest rates low, but it's not going to be targeting a specific interest rate. They're not targeting a specific price for what they're purchasing. If they were targeting a specific price or a specific interest rate on those treasuries, what they would end up having to do is purchase any amount, regardless of how many get sold, with their unlimited pocketbook. This would give others who are holding that asset an incentive to sell at the artificially high price, because they know that no matter how many they sell, they're not going to push down the price and ruin the value of everything else that they're still holding while they're trying to unload. So at this point, you're probably wondering, what in the world does this have to do with the fact that interest rates are going up right now? Well, number one, we needed to cover what the Federal Reserve is doing to influence interest rates right now. They're not targeting specific interest rates, but they're just providing buying pressure to those bonds to keep those interest rates lower than they would be without them there as a buyer. And now what's happening is the market is starting to price in the reality that that buyer is going away. That's why the 2-year spiked to 0.26%, the 10-year spiked to 1.43%, the 20-year spiked to 1.89%, and the 30-year is up to 1.94%. Big moves in interest rates all across the curve and larger towards the shorter end because, again, the biggest buyer is leaving and the pricing is going to be not completely, but more so determined by free participants. So number one, people are front running the Fed here. They're saying if the biggest buyer is leaving the space, that means prices are going to come down. And so I'm going to sell right now so I can sell before prices come all the way down. And it becomes a self-fulfilling prophecy because then everybody sells and brings those prices down. Now, the other thing that is influencing interest rates is the increasing awareness that inflation is here to stay and is likely more severe than many people had originally thought. Because if I'm going to loan you money, the only way I'm going to loan you money is if the interest rate that you're paying me, the dollars that you pay me back, will buy me at least the same amount of stuff that those dollars would have bought me when I originally made the loan. Because if I give you $100 and you give me $101 back, but by the time you give it back, everything that used to cost $100 now costs $102, I've lost money. And for a long time, interest rates have been negative once you've adjusted for inflation. So anybody buying a bond, anybody lending money has been losing purchasing power. Now, the reason this was the case is because you had somebody in the market lending money that didn't care about profitability. And that's just another way of saying you had the Federal Reserve printing money out of thin air to buy up treasuries. Same thing, artificially keeping the interest rates down. But now as that buyer starts to leave, you start to have the bond market pricing in inflation more than it used to be. And then finally, the other factor that might be contributing to this short-term spike in interest rates, especially given the fact that they didn't really start to move right after the FOMC meeting, the press conference on Wednesday, but they started to move more on Thursday, might have something to do with the fact that Biden has just warned federal agencies to start to prepare for a government shutdown. And while a government shutdown would be able to occur before the Treasury completely runs out of emergency funding to fulfill its main obligations like Medicare, military, and especially principal and interest payments on its debt, it is still a step in the wrong direction. And so it looks like interest rates might ever so slightly be starting to price in the small possibility that the federal government cannot get their things together and figure out a solution to the debt ceiling and either suspend it or raise it by the time they run out of money and potentially default on their obligations, their principal and interest payments. Again, very small possibility, most likely won't happen, but it looks like interest rates might be starting to price in a small possibility of default. So I hope that helps, just an explanation of some of the reasons that we've seen going into the spike in interest rates across the yield curve on Thursday. As always, really appreciate you guys. Thank you so much for watching. Have a great day.